morning, everybody. First of all, I would like to thankful for the iCapital Academy for giving this wonderful opportunity. So iCapital Academy and Corporate Advisory LLP, empowering the growth through competitive knowledge. So iCapital Groups Companies, iCapital Investment Managers Private Limited, iCapital Academy and Corporate Advisory LLP, iCapital Wealth and Distribution Services, iCapital Research and Financial Services. So let's moving on to the next slide. So this presentation by Kiran SM. So this is a consent note. I hereby grant permission to iCapital Academy and Corporate Advisory LLP to use the video presentation as assessment test and MCQs created content social media platforms, website, or through any other medium they deem appropriate. I confirm that I have no objection to such use. So let's dive into the my exact presentation topic, that is the value of value-based management. This particular topic will try to understand one simple story. I'll start up with my own I am pursuing final year Master of Business Administration. So when we are studying in the first semester, we usually look for if the company is earning profit, then and there only the company is performing well. So if the company is earning profit, yes, the company is doing well. So after the second semester, we got to know that profit is not the metric for assessing the performance of the company. So we need to look for a cash flows. If the cash flows is positive, then and there only, yes, company is doing well, company is making some amount of wealth to the wealth to the shareholders. We got to know that in the second semester. After coming to the third semester, we have one subject called corporate valuation. There it is a clear picture will got to know that if the company's free cash flows is positive, then and there only the, yes, company is making some amount of wealth to the shareholders. If let's say 1 year free cash flows is negative, that is not the case of company is not doing well. And that particular year, the company would have invested some amount of money in some potential projects that's going to be that's going to create some huge amount of wealth to the company in the coming future. So that is not the metric for the to assess the performance of the company. We need to look for other things as well. So let us try to understand with the help of real world case studies and some practical illustrations. Let's moving on to the next slide. So increasing firm's value through value-based management. The main objective of every corporate companies is to maximize the shareholders' wealth. So this is the main funda of the every corporate company's goal or objective, we can say. So let's moving on to the next slide. So when it comes to introduction part, a business or a company main objective is to maximize the shareholders' wealth. So their objective already clear and very value is created only when the rate of return is higher than the cost of capital. As we all know that there are source of capital is there. When the company is borrowing some amount of money to the company to run their business, to run their operations, so that some amount of money the company should pay. So that is the cutoff rate, we can say, or we can say cost of capital, or we can say in corporate valuation term discount rate as well, and also WACC, weighted average cost of capital. Over and above, if the company is generating return, then only we will get to know, yes, company is creating some amount of value to the business. Let's moving on to the next slide. So objectives. So this particular presentation's main objective is about understanding the meaning of the value-based management and value-based metric and measures and value creation. So what are the challenges in implementing the value-based management? Let's moving on to the next slide. So how exactly this value-based management framework has designed, we'll try to understand. So this value-based management framed with the help of strategic decisions, financial decisions, and corporate governance. So value creation defines the corporate value and explains the key drivers of the value. So this let's say company's true worth will defines the it defines the yes the company have a true potential, then strategy. So nowadays strategy is the key for in this competitive world. This helps the company to stand out in the market. So and also sources for running their business, which also matters in creating a wealth to the shareholders, and also their strict and norms and policies. Corporate governance also plays a vital role. Let's moving on to the next slide. So value-based management, value creation. So I earlier I already discussed this. Rate of return must be greater than the cost of capital to generate some amount of value to the business. Otherwise, the company is not able to meet the at least minimum requirement. So this whatever the company is generating over and above cost of capital, then automatically it attracts that particular company's stock price, and also it boosts the investors' confidence as well. So sustain and leverage on employees' intellectual capital. So this also motivates the towards company interest, and it builds the trust among the employees as well. So moving on to the next slide. So value driver linked to value creation. What are the value drivers which are involved in the um, to creating a value to creating a wealth in the to the shareholders? Will look into. So growth drivers and efficiency drivers and financial drivers. Under growth drivers, invest in value creating growth opportunities. Whatever the, let's say there are other strategic tools are there in the value based management. Let's say usually companies invest which projects are giving over and above discount rate return, then on that particular projects only they usually invest. This is the mantra for the every corporate companies. And also efficiency drivers, they usually invest in operating efficiency, which let's say their uh, main revenue generating one particular company have their lots of product lines. In that particular product lines, whichever products which are not doing well in the market, they usually stop to they usually not they usually stop that particular good to produce, because it erodes the value of the company. So after that, financial drivers, reducing the cost of capital, which also drives the value creation in the company. Let's moving on to the next slide. So practicalities in value-based management. Let's try to understand what are the practical things are involved in the value-based management. Introduction. So value-based management is a management control system focused on maximizing the shareholders' value, aligning the strategy, operations, and performance metrics with long-term value creation. So value-based management, it is not for a short-term goal or short-term thought process. They always look for a long-term value creation. So value-based management integrates financial theory with strategic and economic perspective of the firms. So here under this, there are some key points are there. So under that definition, value-based management measures, encourages, and supports the net worth of the creation. So the company invested in the earlier, let's say, I'll explain with the help of one simple example. Let's say the company would have invested some amount of money, like let's say 100 rupees. If the company able to make it 150 rupees, then and there only, yes, there are some, there is some value is or value based management encourages and measures that particular value. After that, origin, the term value-based management introduced by the Taggart et al. Linking corporate strategy to the market value. The main core objective, as I already discussed, sustainable shareholders creation, long-term value creation to the shareholders. Let's moving on to the next slide. So there are 5 institutional value drivers are there. The first one is governance and strategic planning, and also proper resource allocation and performance management, top management compensation. So there are some metrics also integrates. So metrics aligned across key functions and processes, and this economic value added, their main focus is central to the value-based management for tracking, driving value creation. This is the one of the EVA comprehensive approach for the valuing the business. So with the help of EVA approach, we will get to know true exact value of the company. And performance signal, so must correlated with the shareholders return and reflect the periodic wealth generation. So let's moving on to the next slide. So value-based management is enabled by 2 key components. One is a value creation mindset and a set of management process and systems. So this value-based components, like value creation mindset. So a value creation mindset means a senior manager or whatever the board of directors, they are fully aware that what is the exact objective is in their organization. The main objective is maximizing the value of the company, and they have a clear rules for deciding when the other objectives, for example employment, environmental goals, and outweigh this imperative. So they have a strong understanding of which performance variables drive the value of the company. So and also this value creation mindset are aligned with the management process and systems. So management process and systems encourages the managers and employees to behave in a way that maximizing the value of the organization. This will be done by planning and target setting, performance measurement, and incentive systems are working effectively when the communication and surrounding them is tightly linked to the value creation. So let's moving on to the next slide. So methods of the main core of this particular value-based management, there are some methods, approaches are there in value-based management. So father of shareholder value is Alfred Rapport. So for time being, try to understand. In the further slide, I'll explain you in detail free cash flow approach, McKinsey and like Alker approach, Alker group, the EVA economic value added, market value added, Stein, Stewart and Company, CFROI and CVA, BCG and Holt Value Associates, Marathon Approach and Marathon Associates. These are the different approaches or different methods are in value-based management to assess the performance or true worth of the company. Let's moving on to the next slide. So these approaches are based on common parameters. So the first one is value of the company is equal to the present value of future cash flows. So whatever we are forecasting with the help of one discount factor or cost of capital, we are forecasting that present value of future cash flows. So conventional accounting earnings are not sufficient indicator. They are not cash flows. So in the accounting treatment, profit is not the key metric for identifying the performance of the company, identifying the value. Is there any value generation is happening in the company? For that, profit or measurable cash flows is not the indicator. They are not cash flows. So firms should create shareholder value, follow all principles of financial management. The performance measurement system and incentive compensation should be linked to the shareholder value creation. So let's moving on to the next slide. So major difference between earning per share and value-based management we'll try to understand. So this particular earning per share. Usually, to determine earning per share, we usually use net income after meeting all the financial obligations. Let's say in the net sales, we usually deduct COGS. After that, we will get after that we will get EBITDA. In that particular, we will deduct depreciation. After that, we will deduct interest components. After that, we will deduct tax. After that, preference dividend. Then and there available whatever the net income is available. With the help of that, we will ascertain EPS, earning per share. When it comes to value-based management, we usually use to forecast the present value of future cash flows. For this, we usually use cash flow as a proxy. So this is earning per share is subject to managerial discretion. So this is the one of the standard process of calculation. So value-based management is a standard process of calculation. So this in this earning per share, we do not consider the cost of capital. Value-based management incorporates the capital charge, and then earning per share can be destroyed, distorted by off-balance sheet assets and liabilities. When it comes to value-based management, it adjusts, and it usually adjusting of balance sheet assets and liabilities. So these are the main key differences of earning per share and value-based management. So let's moving on to the next slide. So let's dive into the first approach, that is a Alker approach. So Alker approach is a one software consulting group where value-based management model based on the discounted cash flows analysis, and it was developed by the Alker group. It is renamed as a Corporate Performance Systems. It is a management, education, and software company. So the Alker approach focuses on their main focus is about cash flows and avoids accounting based methods for calculating the shareholder value created. So how this shareholders value creation happens? So we'll try to understand with the help of one simple structure, one simple flow chart, that is a corporate objective. Their main objective I already discussed. I already spoke this thing. Creating the shareholders value. This is the main objective of every corporate company's aim. So shareholders return and dividends, capital gains. So the value components, value drivers, management decisions. With the help of these management decisions, the company can maximize, the company can create value to the business. So in that operating by increasing their sales growth, by increasing their profit margin, and by cutting off getting some tax shields, income tax rates, we also creating some amount of value to the business. And also investment. So how well the company is using working capital and fixed capital investments, and also financing, how well, as we all know that ideal capital structures, debt to equity ratio is 2:1. So this also influences the cost of capital. All these drivers which influences the cash flows, and also discount rate, as well as and also debt. So let's moving on to the next slide. So this Alker approach flowchart for value-based management, how it exactly works, we'll try to understand with the help of one flowchart. That is step one, what we usually do in this Alker approach. So in the first stage, we usually forecast cash flows, projecting the operating annual cash flows over the planning period. Let's say we have a cash flows of 2025. Some amount of cash flows we need to forecast for next 5 years. So for that, in the initial stage, we need growth rate. So after that, we will try to we'll try to understand in the next step, that is discount operating cash flows. So for discounting, for forecasting, in the first stage, we usually use the growth rate for forecasting for next 5 years. For whatever we have forecasted, those cash flows are we need to discount it for present value. For that, we need discount. Discount or WACC, weighted average cost of capital, to discount forecasted cash flows. We usually use, and we will future, we will discount it for present value. In the third stage, we will calculate residual value, that is terminal year, that is residual value. So the company has no perpetuity value we need to calculate. So for that, perpetuity cash flows divided by cost of capital, we will get a residual value. In the fourth step, we will compute total firm value by adding present value of all the cash flows and plus present value of residual value. So after this is the enterprise value, whatever we get. So in that, we deduct market value of debt. After deducting value of debt, whatever the amount left out for, which is free cash flows to the equity. Free cash flows to the equity, which means after meeting all the current and future financial obligations, which are exclusively available for the equity shareholders. So this is, we call it as FCFE, free cash flows to the equity. So when it comes to step 5, establish pre-strategy value. So in the Alker approach, in the fifth stage, what we will ascertain that establishing the pre-strategy value. We usually ascertain that we will ascertain pre-strategy, and after that we will calculate for post-strategy, and then we will compare with the pre-strategy value and post-strategy value. If the post-strategy value is greater than pre-strategy value, then we will recommend company to implement that particular strategy. If not, we will recommend company to maintain a status quo. Then in the step 6, calculate value created. So value created, post strategy value minus pre strategy value. As I already told you, difference, if it is a positive, yes, then the strategy implementation is preferable. If not, company to maintain a status quo. In the step 4, we analyze value drivers like sales growth, profit margin, working capital, fixed investment, tax rates, cost of capital, value growth, duration. These all are the drivers of that particular company's cash flows. Let's moving on to the next slide. So this flow chart we can understand with the help of some simple terms. The Alker approach suggests the following steps for calculation of value generated through adoption of specific strategy. This particular Alker approach is about the company is doing their whatever their operations, they need to implement one strategy. So they need to implement one particular strategy. With the help of that particular strategy, they need to create some amount of value to the business. So this Alker approach says that is there any value creating after implementing that particular strategy? If not, they will suggest that the company to not to implement that particular strategy. This is all about Alker approach. So as I already spoke with this, forecasting the operating annual cash flows for the over the planning period. Let's say I am planning for next 5 years. What is the cash flows of this particular company next 5 years? When it with respect to 2025 cash flows, how can I forecast it? With the help of growth rate we can determine. We can determine by like current year earnings minus previous year earnings divided by previous year earnings into 100. We will get the exact amount of growth rate. We can take it like past 5 years we can calculate for growth rate, and we can average it, and we can use that particular figure for growth rate purpose. And also when I gone through some annual reports, in the management report also they have mentioned some amount, some, let's say they have that they know, company know what is the growth rate of that particular company in the next 5 years. They have mentioned that also. We can incorporate that particular growth rate as well. And after that, discount the forecast operating cash flows stream using weighted average cost of capital. So this WACC will be computed by cost of capital, that is a CAPM model, and then debt capital. So by integrating these both, we will get weighted average cost of capital. With the help of this WACC, we can discount it for present value. after discounting future cash flows to the present value, estimating the residual value of business plan or strategy at the end of the period and find its present value. The residual value can be calculated by dividing perpetuity cash flows by cost of capital. So let's moving on to the next slide. So calculate the total shareholders value, which is equal to the present value of operating cash flows. In the first stage, we have done this one. So by adding that present value of residual value, we will get the enterprise value or value of the firm. By deducting market value of debt, we will get exclusively the amount which is available for the equity shareholders. We will get free cash flows to the equity established. After that, fifth stage is about, I already discussed this. We need to obtain pre-strategy value. After that, post-strategy value. We need to compare that both. If the post-strategy value is more than pre-strategy value, yes, the company is creating, it is good to implement new strategy. If not, we will recommend that the company, the whatever the implementing strategy that is eroding the shareholders value, we will not recommend the company to implement strategy. We will recommend that company to maintain status quo. So after that, calculating the value created by this strategy. So let's moving on to the next slide. So in this particular Alcar approach, what are the value drivers? One is a rate of sales growth, how well the company, let's say last year the company made a 5% above growth. I mean sales grown by 10%, grown by 15%. Over a past 5 years, what is the growth rate? This is also one of the metric for calculating the cash flows. After that, operating profit margin, income tax rate, investment in working capital, fixed capital investment, and cost of capital, which means discount rate or weighted average cost of capital. These are the value drivers available for in the Alcar approach. So value growth, duration at which the rate of return is greater than the cost of capital, comparative advantage, and corporate strategy. This is a strategy that over and above cost of capital, which means yes, company is creating a value to the business. Let's moving on to the next slide. So here we will understand with the help of one practical illustration on Alcar approach. So the income statement and balance sheet for the 0 year, let's say I already discussed in the earlier. Let's assume this is the problems income statement of 2025. We are going to forecast next 5 years of sales and profit after tax and balance sheet. We are going to forecast loss. Let's try to understand first. Let's try to understand the illustration. So this is the one simple income statement and also balance sheet. This is the base year figures. We'll look into that. So income statement, sales is 10,000. So in this gross margin is 20%. In this 10,000, 20% is the gross margin. Whatever the 80%, I mean 80,000 is about COGS, cost of goods sold. So gross margin is about only 20%. In that 20%, I mean in that gross margin, selling expenses is 10%. So 10%, which means 1,000. After deducting 2,000 minus 1,000, we will get profit before tax. So tax, if not given, that is a standard assumption that 30%. If not, they will mention. So for time being, let us try to understand here 30%. So profit before tax is 1,000. By calculating 30% of tax rate, we will get 300 for tax. After deducting tax, we will get profit after tax. So which is exclusively, I mean, profit after tax after meeting all the financial obligations, which this particular PAT is available for equity shareholders. PAT, we call it as amount available for equity shareholders as well. So in the right side, we can see one simple balance sheet that equity shares is 6,000, sorry. Fixed assets is 4,000 and current assets is 2,000. By adding all this, equity shares is equity capital is 6,000 and asset side 6,000 is equal. Let's moving on to the next. So this particular F, limited F Limited is debating whether it should maintain status quo or adopting a new strategy. So if it maintains status quo, sales will remain constant at 10,000. So it is not going to implementing the new strategy. It is maintaining status quo. Still, it is remaining status quo. There is no change in the sales. That is exactly 10,000. So gross margin will be remain 20,000, 20% of 10,000, and selling and general expenses will be 10% of sales. Depreciation charges will be equal to the new investments. So the asset turnover ratio will be remain constant. The discount rate will be 15%. So discount rate I already discussed this. Discount rate or WAC, weighted average cost of capital. Uh, same things, that is 15%. 30% if the company adopts. This is the Alker group usually recommends whether the company to implement a new strategy or maintain a status quo. We'll try to understand with the help of this particular illustration. If the company adopts a new strategy, let's say F Limited adopting new strategy, so then the sales will grow at a rate of 20% over a period of time. Let's say in the 2025 F Limited is implementing one new strategy. So this particular new strategy is going to increases, or sales is going to grow 20% per year for the next 3 years. So what will happen for the what is the effect of cash flows? We'll try to understand. So the margins, turnover ratios, capital structure, income tax rate, discount rate will be remain unchanged. There is no change in that. So depreciation charges will be equal to the 10% of the next fixed assets at the beginning of the year. So what is the value will the new strategy will create? So in here we'll try to understand. They have given base year figures. We need to forecast it. We need to figure it out for pre-strategy value and for post-strategy value. After comparing both, if the post-strategy value is greater than pre-strategy value, yes, strategy is creating some amount of value to the business. So Alker Group will recommend, yes, implement this particular strategy in your company. Otherwise, this particular strategy is going to erode your shareholders' value. We will never recommend company to invest, company to implement that particular strategy. We'll try to figure it out. Okay. Computation of pre and post strategy value. So company has a new strategy to be implemented. So pre-strategy value will be for pre-strategy calculation. One particular calculation formula is there. So profit after tax divided by cost of capital. After calculating this, we will get the pre-strategy value. So in this pre-strategy value, what is happening? We are not implemented still strategy. Before implementing a strategy value, what is the value? 4,667. So PAT is 700 divided by 15%. After computing this, we will get 4,667. What we need to do? We got pre-strategy value. We need to obtain post-strategy value. For this, we need to forecast that post-strategy value. Like we need to forecast sales. So 20% next 3 years, the company is able to generate 20% more of sales. So we will try to understand in the next slide. So let's moving on to the next slide. That is a post strategy value. So here income statement projection we need to do. After that balance sheet we need to do. After that we need to obtain cash flows. After that with the help of WAC, that is a discount rate, we need to discount it for present value. After that we will obtain post strategy value. So here this is the base year. As we all know that already in the sum they given in the base year, that is 0. What is the what is the projection for next 3 years? They have given already 20% sales is going to grow. So we'll understand that sales is given in the first base year, that is 10,000. Let us try to understand in 2025 the company sales will be 10,000. So gross profit margin remains same, that is 20%. Sales and distribution is 10% remains same. Profit before tax will be 10,000. After deducting 2,000 minus 1,000, we will get a profit before tax, that is 1,000. After deducting 30% of tax, we will get 700 as profit after tax. So they already clearly mentioned that this particular sales is going to increase by 20%. So 10,000 into 20%, when we compute, we will get 12,000. On this 20%, we will compute 20% of 12,000. We will get some amount of some amount. We need to add that particular amount to the 12,000. We will get 14,400. So this particular 14,400 into 20%, we will get some amount. On that, we need to add for 14,400, we will get 17,280. These are the forecasted sales for the next 3 years. They already clearly mentioned 20% is going to grow every year, every year to the next 3 years. So as we all know that gross profit margin will be 20% of that sales. So in the base year, that is 20% of 10,000 is 2,000. So 20% of 12,000 is 2,400. 20% of 14,400 is 2,880. So 20% of 70,280, which means 3,456. So distribution and selling and distribution expenses are remain constant, that is 10%. So 10% of 2,000 is 1,000. So 10% of 2,400 is 1,200. 10% of 2,880 is 1,440. So 10% of 3,456, which is 1,728. After deducting 2,000 minus 1,000, we will get 1,000. 2,400 minus 1,200, we will get 1,200. 2,880 minus 1,440, that is we will get exact which are equal to the same amount, that is 1,440. 3,456 minus 1,728, we will when we subtract it, we will get 1,728. On these amounts, we need to calculate 30% of tax. So in the base year, we all know that on 1,000, 30% of tax rate will be 300. So for 1,200, 360. For 1,440, 432. For 1,728, 30% of tax will be 580. So after deducting tax, we will get profit after tax. So this particular profit after tax, which is very much helpful for obtaining the cash flows of this of this particular company. So let's moving on to the next slide. So here we need to project the balance sheet values. So as in the base year given, they have given already fixed assets is 4,000, current assets is 2,000. We will get a total amount of 6,000. So equity and liabilities, equity shares will be equity capital will be like 6,000. And this is the total liabilities. So this particular assets is equal to the total liabilities. This is the base year figures. So we need to forecast for next 3 years. That is 20% is going to grow. So on 4,000 into 20%, we will get 4,800. For next year, 5,760. For third year, we will get 6,912. So current assets, we will same thing on 2,000. We will when we compute 20%, we will get 2,400. For second year, 2,880, 3,456. Same thing. After adding these fixed assets and current assets, we will get total assets for all the years. And next, same thing on 6,000, when we compute 20%, we will get first year equity capital, that is 7,200, 8,640, 10,368. So this is the total liabilities. These total liabilities are equal to the total assets. Why this particular projection is important, I'll explain this in the next slide. Let's moving on to the next slide. Here you can see we are computing the free cash flows. So free cash flows. For free cash flows, we need to add for profit after tax, we need to add depreciation. Then only we will get cash flows. So in the first year, how much profit after tax is there? We'll try to understand here. See, you can see over here in the first year, profit after tax is 700. We projected for next 3 years, that is 840. and 1008 and 1210. We need to incorporate all these in the computing cash flows of the company. See here, I have mentioned profit after tax for our base year is 700, and then first year is 840 and 1008 and 1210. For this, we need to add depreciation. When we add back depreciation, we will get cash flows of this particular company. So for first year, you can see over here, for first year, there is no depreciation is involved because here 10% of 10% of depreciation they given in the problem. So here, so you can see here fixed assets. So depreciation always we need to we need to charge for on the fixed assets. When we charge on 4,000, we will get 400. See here, I have mentioned. So in the first year, we are not able to get. So because for that, in the earlier year fixed assets which is required, so that which is not available. Let's try to understand in the initial year depreciation is not involved. So on 4,000, when we compute 10% of depreciation, we will get 400. On 4,800, when we compute 10%, we will get 480. And after that, 576. When we add back this particular depreciation to the PAT, we will get PAT means profit after tax. So when we add back this particular depreciations to the profit after tax, we will get cash flows. What we need to do with these cash flows? So we need to obtain free cash flows with the help of these cash flows. These cash flows will be this cash flows will be we will compute with the help of these cash flows. Free cash flows. Here I have mentioned free cash flows in the base year is 700. In the first year 1240, 1488, 1786. So in this cash flows, we need to deduct net capex and changes in working capital. Then and there only we will get free cash flows. This is exactly similar to the discounted cash flows. So in cash flows, when we deduct net capex and changes in working capital, we will get exactly free cash flows. What is the exact amount of free cash flows to the firm? So this particular net capex, let us how did I obtain? I will explain you. So here, net capex will be traded on total assets. Here in Alcar approach, we need to treat it like net capex on total assets, like yes. Let us try to understand. So we got now free cash flows. So now we got free cash flows to the firm. So now we need to discount it for present value. This is the future cash flows. So we need to present it for present value. We all know that 15% is the discount rate. This is the discount factor. So need to we uh, we got total present value. need to compute for continuing value. For that, profit after tax 210 is a profit after tax of a third year. 1210 of compute discount with the help of discount factor. We will get 8,000. We need to this is the we need to make it 8,067 into third year discount factor is 0.6775. When we compute when we determine, we will get 5,300 and 304. Value of the firm will be present value of total present value of free cash flows. Here we got minus 980. After that, plus what is the continuing value, present value of continuing value, that is 5,304. When we deduct present value of free cash flows is in the negative sign. So when we deduct 980 minus, plus 5,304, we will get 4,323. So it is clearly shown that the whatever the implemented strategy creating any value to the business, that is rested on the new strategy eroding the shareholders wealth. So this particular illustration speaks about whether to implement a new strategy, or keep it as it is. Company to recommend maintain a status quo. I will explain one more general example. Let's say one MNC company is serving coffees. Usually they will serve coffees. Hard drinks to the employees in the evening times, like at 4:30 or 4 o'clock. What they do, as of now, the company is serving around 5,000 cups a day to the employee, serving to the on table, where they can plan, where they can open one coffee cafe in their in their company. One corner. Let's say in the break time, they can go and they can have one particular place there. There are some amount of huge amount of value is they are paying to serving to their on table. When it comes to one particular place, they can minimize the cost hard drinks to their employees. With the help of strategy, whether to implement that particular strategy or not, we will get to know is that particular strategy is creating some amount of value to the business or not. So let's moving on to the next slide. So just a minute. So this is also an illustration on different strategies implemented, and which strategy is giving value to the business. We will get to know after computing all the strategies value. So the given of A limited are available. So the base year figures will be like is the operating profit after tax, that is 2000. Cost of capital or weighted average cost of capital, that is 15%. Rate of return is 20%. So with the help of here, we can get to know that cost of capital is 15%. Rate of return is 20%. So here only we can get to know that yes, the company is creating some amount of value to the business. Here the company is generating returns to the company over and above cost of capital. So the chief financial officer identifies 4 strategies to be implemented. So they have implemented almost 4 strategies. But in that 4 strategies, which strategy is generating more wealth or more value to the business? We will ascertain that. So first strategy is about improvement in operating performance. That is NOPAT increases from 2000. As of now, 2000 is the base year NOPAT. So it is increased almost around 2250 due to greater operating efficiency. They have that efficiency of operating. They generated the sales is going. So this raises return on investment from 20% to 22%. So in the initial stage, what is the rate of return? 20% is the rate of return. Now it increases to 22.5%. When it increases to 22%, 22.5%, what is the effect on cash flows of that particular company? What is the value of that particular company? We will get to know, we will ascertain that. So this is the first strategy. Let's dive into the next strategy, that is profitable investment in new project requiring 10,000 is expected to earn a return of 18%, thereby adding 8,800 to the known PAT. So this project increases economic value added So here, the first strategy is about reduction in cost of capital, the capital structure. So the capital structure rebalancing the cost of capital from 15% to 13% unchanged, which when we are deducting with that capital charge, we will get 500 is the yeah. So when we ascertain base case, we will get economic value added around 500. Let us try to figure it out for first strategy. That is just a minute. Yeah. Strategy 1 is about additional revenue. So operational efficiency is going to increasing from 2000 to 2250. What is the effect on economic value added? When we ascertain 2250 minus uh, capital charge, we will get 750 is the economic value added. In the initial case, what happened? 500 is the economic value added. In the first case, it is increasing, that is 750. So let us try to figure it out for strategy 2. That is capital is employing around 20,000. In the base case, 10,000 is the capital. Here, 20,000 is the total capital. So for when we figure it out for strategy 2, we will get economic value added around 800. Similarly, we will ascertain for strategy 3. Here, what is happening? Just a minute. Here, what is happening? Strategy 3. So withdrawal of unproductive capital. In that particular 10,000, the company is not utilizing that 1,000 of capital in a proper way, so that they are withdrawing. This also and also NOPAT declined around 50. So what is the effect on economic value added? So EVA NOPAT minus 9,000 is the capital in this particular case. The same thing into a discount factor, that is 15%. We will get economic value added around 600. So this is the economic value added for strategy 3. So after that, strategy 4, when we ascertain reduction in cost of capital. So in the base case, 15% is the cost of capital. In this strategy 4, what is happening? Cost of capital, they are reduced around 13%. So when we ascertain for strategy 4, economic value added will be 700. When we compare and contrast and when we will get to know that strategy 3, that is withdrawal of unproductive capital, that is no, just a minute. So here you can see strategy 2 is going to creating a shareholder more wealth to the more value to the business. We will get to know that is when we are investing around 10K extra capital, so that the company is able to generate around 800 as economic value added. With this, we will get to know by evaluating all these 4 strategies. So strategy 2 is recommended for a company to implement. So with the help of one simple case study, a real world case study, we will try to understand this ALCAR approach in value based management can be described as follows. The case is about evaluating a new product launch using the ALCAR approach in the manufacturing sector, whether to manufacture one new product or not to produce. We will get to know with the help of this particular case study. So a manufacturing company is considering that launching a new product. They are planning to launch a new product. They are trying to bring some innovative products to the market, so that they come out with one new product. So they are in the plan that they need to produce new product, that is management wants to determine whether this strategy will add value to the firm. So they want to know how they will get to know with the help of this Alcar approach. They will get to know the whether to produce that particular product or not. So the company applies the Alcar approach, which uses the discount cash flows analysis and focuses on 7 key value drivers. So the same thing, say sales growth rate, operating profit margin, income tax rate, incremental investment in working capital, incremental investment in fixed assets, value growth duration, and what is the cost of capital. These are the drivers which drives the value of the business. So with the help of some steps are involved. So estimating the cash flows without the strategy. So without the company is not still produced or launched that particular new product, what is the cash flows? We will ascertain first. The company first calculate the present value of the expected cash flows from its existing business, considering its normal growth rate, required investments, and the weighted average cost of capital. So we will ascertain in the first stage. So then in the next step, what we need to do, estimate the cash flows with the new product. So after the launch of new product, what is the cash flows? Next, the company projects the, as in the earlier first illustration, we will get to know what is the how to forecast the next 3 years or next 5 years cash flows or next 5 years sales. So here also they are doing like same thing is happening. The company is estimating the projecting the incremental cash flows from the launching a new product line. So this includes estimating the higher sales growth, changes in profit margin, additional investment is any needed, and the duration for which above normal growth can be sustained. So discounted cash flows, this will be both sets of cash flows with or without the strategy are discounted using the company's cost of capital in the third stage. So in the fourth stage, what happens? Comparing the equity values, the present value of the firm is equity is calculated in both scenarios by subtracting the market value of the debt from the total firm value. The equity value with the new product line is higher if the equity value is higher than the prior. So the strategy is considered value adding and it should be implemented. Yes, this by launching this one new product, by launching this one new product line, yes, this particular product line is going to create some amount of value to the business. In the conclusion, what happens by comparing the present value of firm's equity with and without the new strategy product launch, the company makes an objective value-based decision. This practical application of the Alcar approach ensures that only strategies which increase shareholders are pursued. The whole funda of this particular Alcar approach is about whether to implement, should I implement this particular strategy or not. So with the help of that present value of future cash flows, we will get to know whether to implement that particular strategy or not. So let's moving on to the next. So economic value added. Before getting into economic value added, why this approach? So we have already discounted cash flows approach, that is a two-stage model is there, three-stage model is there. Still most of the companies are using discounted cash flows not for to ascertain the true intrinsic value of the firm. Why they are not incorporated economic value approach? Because to ascertain economic value approach, there are some complexities are there. So they still most of the companies are not adapted. Only two companies are adopted. One is Infosys and HUL. No one company has adopted this particular approach because this EVA gives more comprehensive approach to the firm value. Because in the DCF approach, what happens? Some accounting treatments are there that misleads the true worth of the company. So there are around 160 accounting treatments are there. All those accounting treatments are going to destruct that particular value of the firm. So when it comes to EVA approach, yes, we can say that in the next 5 years, in the next 5 years down the line, every company will definitely adopt this particular economic value approach. We will try to understand around 4 to 5 sums. Then only we will get to know what is the exact true worth of this particular approach. So economic value added is about So the surplus profit which are left after charging the capital employed or capital charges of the capital employed, we will get exact economic value added. Economic value added or economic profit is a measure based on the residual income technique that serves as a indicator of the profitability of projects undertaken. Its underlying premise consists of the idea that real profitability occurs when additional wealth is created for shareholders, and only projects that create returns above their cost of capital should be considered. So EVA is all surplus left after making an appropriate charge for the capital employed in the business. So as I already discussed, this is the more comprehensive approach, because here we are considering capital charge mainly for surplus left after making all the appropriate charges. Okay, so for this economic value added, the standard formula for economic value added is NOPAT, net operating profit after tax, minus WACC into multiplied by invested capital. We will get economic value added. These are the alternative formulas for this. Let's moving on to the next slide. So we will get, so this economic value added, this is a decomposition chart. So this is the component, this is the formulas. So economic value added, basic definition is about economic value added. We will get when we charge capital employed, whatever the let's say we borrowed around 200 rupees of capital for company to run the company. So for that we need to meet some amount of financial obligations. So we would have earned some amount of profit. We are subtracting this particular capital charge from the NOPAT, which means net operating profit after tax. So when we subtract, we will get exact true worth of the true value of the economic value added. So alternative EVA formulas are EVA is equals to invested capital into ROC, return on capital minus weighted average cost of capital. EVA is equals to profit after tax minus ROC. This one is ROC. Wait, just a minute. So economic value added is equals to profit after tax minus ROC. No. So let's moving on to the next, that is NOPAT, net operating profit after tax. So net operating profit after tax, to obtain this particular NOPAT, one formula is there, that is EBIT into 1 minus tax rate. We will get NOPAT. One more formula is there, that is NOPAT is equals to profit after tax plus interest into 1 minus tax rate for obtaining net operating profit after tax. So for WACC calculations, we already know that weights of equity into cost of equity plus weights of debt into cost of debt minus 1 minus tax rate, we will get WACC. So capital invested, total capital employed in operations, equity plus debt adjusted for accounting treatments. So ROC, return on capital employed, return on capital. So this will be obtained with the help of NOPAT divided by capital employed. So what are the value drivers involved in the EVA, economic value added? So that is operational efficiency, value added investments, reduced WACC, and increased ROC. These are the value drivers. So accounting adjustments will be like, here what happens, in accounting treatments, research and development expenses will be treated as revenue expenditure. Actually, actually, when it comes to reality, research and development expenses, whatever the company spent, that particular expenses incurred for that particular year only. But whatever the company incurred on research and development expenses, that expenses is going to create value to the business in the next 5 years. How we can treat it as a revenue expenditure? We, in the accounting treatment, that is one of the drawback for the accounting adjustments are there, and also some amount some adjustments in goodwill as well, and added back provisions, LIFO reserves, etc. So strategic insights will be separate investment and financing side, use cash taxes over the book taxes here. we are using cash taxes over the book taxes. Let's moving on to the next slide. That is factors that lead to increase in EVA. Which are the factors that leads that creates economic value added? Increase in operational efficiency, value added investments, decrease in value weighted average cost of capital. When rate of return on existing capital increase because of improvement in operating performance. So when operating profit increases without infusion of additional capital capital is invested in the business in projects that earn a rate of return greater than the cost of capital. So as I already discussed this as well. So capital is withdrawn from the activities which earn inadequate returns. The WACC is lowered by altering the financial strategy by making some capital structure decisions. We will make WACC as lower. So let's moving on to the next slide. That is here we will get to know what are the adjustments are involved in the accounting treatment in the accounting approach. So here we are not considering in economic value added accounting treatments we are not considering, so that only this is the more comprehensive approach when we compare to DCF approach. So economic value added is a superior measures to EPS, earning per share, or net present value. Stewart and company have recommended that 160 potential adjustments to GAAP generally generally accepted accounting principles, accounting related to goodwill, research and development, revenue recognitions, taxes, etc. So let's say depreciation also, let's say in accounting treatment, they usually follow straight line method in the first 2 years, then they will adopt diminishing value method. So these are the distortions in the accounting treatments. So this, to bring accounting profits to economic reality, this is the comprehensive approach for the companies to evaluate their true worth of the company. So expenditure on research and development, as I already discussed, this will be treated as revenue expenditure in the accounting concept. When it comes to reality, research and development expenses, these expenses are going to generate the revenue to the company in the next 5 years. So employee, whatever that we are giving, companies are giving employees to train some developmental activities, that trainings is going to generate revenue to the company next 5 years. So we can't call it as a revenue expenditure. We need to call it as capital expenditure. So this should be capitalized. So GAAP and in the GAAP generally accepted accounting principles, research and development is expensed, and it is expensed, it is not capitalized. This is also one of the drawback. And economic value added, research and development is capitalized and amortized over 5 years. Here what happens, economic value added, in this approach we are considering research and development expenses as capital expenses, and also we are amortizing it as over the 5 years. So with this we will get economic value of the company. So goodwill also in the GAAP it is amortized. So in EVA it is capitalized and treated as intangible asset that generates the value over time, and hence amortized value is added back to the notepad. So these are the accounting depreciation should be accounting depreciation. Sorry, accounting depreciation should be added back to the profits. Create economic depreciation. There what is happening, straight line methods are they are adopted in the accounting concept. Here we are creating economic depreciation which reflects the true change in the value of the assets during a period. Let's moving on to the next slide. So added back provisions for doubtful debts, deferred tax payments, LIFO reserves, etc. to the capital employed. Capitalized operating leases added to the capital employed. Tax charge will be based on cash taxes rather than the accrual based methods used in financial reporting, and will be calculated as follows. Tax charge per income statement minus increase, or if it is a reduction in deferred tax provision, plus tax benefits of interest is equals to cash taxes we will get. So let's moving on to the next slide. So with the help of some practical illustrations, we will get to know what is the exact what is the exact true potential of this particular economic value added with the help of around 4 sums. Let's dive into the practical illustrations. That is, first one is that, but this project evaluation is we are evaluating whether to invest in this particular project or not. We will get to know at the end of this particular problem. So project evaluation, project evaluation using economic value added and net present value. So calculation of economic value added and net present value of the project, evaluating the investment decision making. Here in this particular case, investment is 1000 crore, economic life is 5 years, debt to equity ratio is 1:1, depreciation is adopted here, straight line method, salvage value is not here, nil, tax rate will be 40%, annual revenue is around 2000, annual cost is 1000, that is cost COGS, cost of goods sold. So cost of equity will be 18%, cost of debt post tax, so that is 10%. So here we will first we will ascertain economic value added. So here what we need to do, we are ascertaining for next 5 years, I mean 5 years. So first we need to know what is the exact annual revenue. In the problem itself, they have mentioned that revenue is around 2000 for every year. So that is 2000, 2000, 2000, 2000. I have mentioned, I have incorporated here. In this particular annual revenue, we need to deduct annual cost, that is cost of goods sold. That is, they have given 1000 for every year. After deducting annual cost, we will get 600 as EBITDA, that is earnings before interest, tax, depreciation and amortization. After deducting depreciation, we will get EBIT, that is earnings before interest and tax, that is 400. Then on EBIT, we will deduct interest, that is 50%. I mean, in the problem itself, they have mentioned that, wait, here, just a minute. Trusted. Yeah, interest, after deducting interest, we will get EBIT. So they given 40% as 40% as for tax on 350. So when we deduct tax, we will get 210 as profit after tax for every year. So with the help of this part, we will get to know how this economic value added is creating value to the business. That is, no pat is around, how we will get to fat 240. This particular profit after tax, when we, it is 210, when we add back 200 as depreciation, we will get the exact value of the NOPAT, that is 240 for every year. So total capital is will be like capital will be 1000. For the next year, we need to deduct depreciation, that is 200. In this particular 1000, when we deduct 200, 800. For the next year, total capital is 600. For next year, 400. For the last fifth year is 200. So when we charge capital to the total capital, that is WACC. So WACC is given around 15%. So when we, yes, here cost of capital, no, they straight away they did not given here. We will get to know how to compute this WACC component. Cost of equity they given, cost of debt they already given, and the debt to equity ratio they given 1:1. So here, so first we need to obtain WACC calculation, that is WACC weights of equity into cost of equity plus weights of debt into cost of debt. The given debt to equity ratio will be 1:1. That is weights in 50-50 ratio. In the, see here, 0.5 equity weight and 0.5 as a debt weight. So they have already clearly mentioned cost of equity will be 80%, that is 0.18, 10% of debt post tax. That is, when we ascertain WACC, we will get around 14% as a discount factor. With the help of this discount factor, we will charge capital charge on total capital employed on 1000, that is 140 we will get, on 800 we will get 112, and on 600 we will get 84 rupees, I mean 84 crores, on 400 we will get 56 crores, and 200 we will get 28 crores as a capital charge. When we deduct this particular capital charge on NOPAT, we will get economic value added around 100 and 1028 rupees for second year, 156 crores for third year, 184 crores for fourth year, 212 for fifth year. So discount factor, as now only we ascertain, that is 14%. So this is the discount factor. So 0.8772, 0.7695 for second year, for third year 0.6750, and for fourth year 0.5921, and the last fifth year is around 0.5194. When we subtract, when we ascertain on 100, we will get present value of economic value added. When we accumulate all these present value of economic value added, we will get around 510 as economic value added, the present value of economic value added. So as of next calculation is about net present value. So here cash flows will be around 440. So this will be ascertained NOPAT plus. See, NOPAT is around 240 plus depreciation. When we add back, we will get 440 as cash flows. So discount factor is around 14%. When we multiply it by cash flows into discount factor, we will get present value, that is 384 for and accordingly we will get for 5 years. When we accumulate all the 5 years of present value, we will get 1510 as a total present value. So invested capital is around 1000. So net present value is around 510. So this is a net present value is indicating that it is in a positive sign. So that is, it is economically feasible. We can invest on that particular project. So that particular project is going to create some amount of value to the business. So you can see here economic value added is also 510 crores. Yes, the company is creating some amount of value to the business. So here in this way we can get to know that whether to invest on that particular project or not. So let's moving on to the next illustration. So here second illustration is the same, similar to the first illustration, that is project evaluation using the economic value added, net present value. So if the economic value added and net present value is in the positive sign, or economically feasible, or we will get to know that if it is a positive generation of cash flows, we will get to know, yes, the company is creating some amount of value to the business, we can invest on that particular project. So in the second illustration, that is investment outlay is about 1000. So life of the project is same, 5 years. Debt to equity ratio here 2:3, and tax rate will be 40%. Salvage value is nil. So annual revenue is around 2500. Cost, which means cost of capital, that is 1750. So for cost of equity, they given market price per share 200, growth rate in dividend 5%, current dividend is 10%, cost of debt after the tax is 10%. See here, they did not given on the CAPM model approach, they given dividend discount model. We will ascertain with the help of dividend discount model for the cost of equity. Let's moving on to the next. So here, as I already spoke how to ascertain economic value added for next 5 years. So for the 5 years, so annual revenue, they already clearly mentioned that revenue is around 2500 for each year. So for the 5 years, 2500 is the annual revenue. So cost of goods sold will be around 1750. When we deduct, we will get EBITDA, that is earnings before interest, tax, and depreciation and amortization. So in this particular EBITDA, we need to deduct depreciation. So this particular depreciation will be calculated on investment outlay 1000 minus salvage value. Salvage value is nil, no need of computation. So that is 1000 divided by life of the project, that is 5 years. When we divide with 1000, we will get 200 as a depreciation for each year. When we deduct this particular depreciation on EBITDA, we will get EBIT, that is earnings before interest and tax. After deducting interest, we will get EBIT, that is earnings before tax. As in the problem itself, they have mentioned that tax rate is 40% on 510. So on 510, when we ascertain 40% as a tax, we will get 204 as a tax. So for each year. So after subtracting earning before interest tax, earning before tax, that is 510 minus 204, we will get 306 as a earnings after tax. So let's moving on to the next. So calculation of EVA. when after getting that EVA, earnings after tax, that particular earnings after tax plus depreciation, when we add back that depreciation, we will get no PAT. On that no PAT, when we charge capital charge, we will get exact economic value added. So the total capital is around 1K in the first year. When we deduct 200 as a depreciation, we will get 800. For the next year, say similarly, 200 we need to deduct as a depreciation. So in the last year, we will get 200 as a total capital. So no PAT will be like EAT plus EAT is 306 plus depreciation. We will get 306. So no PAT they already clearly mentioned. Just a minute. So no PAT is around 330. So for each year, when we charge capital, so it is around 101.5. So after deducting no capital charge, we will get economic value added. So discount factor they did not clearly mention. We need to ascertain. So for that, here you can see WACC calculation. WACC is equals to, so here cost of equity into, I mean weights of equity into cost of equity plus weights of debt into cost of debt. So we will get around 10.15% for calculating cost of equity. This particular like 10.25, we need to incorporate here this dividend discount model, that is cost of equity is equal to D naught 1 plus G divided by market price plus growth rate. So here they clearly mentioned that 10 is the dividend, then 1 plus growth rate is around 5% divided by market price is around 200 plus growth rate is 5%. When we subtract, when we compute, we will get around 10.25 as a cost of equity. So here 2.3 is a debt to equity ratio. When we ascertain 0.6 and 0.4 is the weights of the equity and debt. After deducting, after computing, we will get 10.15 as a discount factor. So when we incorporate here a discount factor, so we will get exact present value of EVA. After accumulating all the 5 years of EVA, we will get 1069 as a total economic value added. So economic value added is in a positive sign. It is in a yes, then we will get to know, yes, the company is creating some amount of value to the business. So this project is going to create value to the business. So with the help of net present value approach also, we can get to know whether this particular project is going to create value to the business or not. So as I already discussed, this cash flows will be ascertained with the help of no PAT plus no PAT is around 330. So plus depreciation, we will get exact, that is 530 for each year cash flows. So 10.15% is as discount factor. So this is a discount factor. By multiplying with the cash flows, we will get present value of present value. By accumulating all this, we will get total present value, that is 2001. So invested capital is around 1000. So when we subtract on total present value, we will get net present value. So here it is a positive sign. So this indicates that this particular project is going to create value to the business. So it is economically feasible. So the company can invest in that particular project. Moving on to the next slide. So project, this is also similar to the earlier sums, that is project evaluation using the economic value added and net present value. So here investment outlay is around 5000. Life of the project is around 4 years. Annual revenue, the company is able to generating around 6000 as a revenue. So it is a cost of goods sold or generated cost is around 4000. So tax rate they have clearly mentioned that 40%. Debt to equity ratio is around 4.5%. Cost of equity is around 18%. Cost of debt post tax is 9%. So we need to evaluate this particular project with the help of economic value added and net present value. So similarly, we are deducting a cost on revenue. We will get EBITDA. On that EBITDA, we will get, when we deduct depreciation, we will get EBIT. After interest subtraction, we will get earnings before tax. Tax rate is around 40%. So when we deduct tax, we will get EAT, exact EAT. So here calculation of EVA similar to the earlier sums. So capital employed in the first year is around 5,000. When we deduct 1,250 as a depreciation, we will get second year capital employed, and the last year capital employed is around 1,250. NOPAT is around 450. So when we deduct the capital charge on NOPAT, we will get EVA, economic value added. On economic value added, with the help of discount factor, when we multiply with, we will get a present value of EVA. Accumulating all these present value of EVA, we will get a total present value, that is minus 50.74 is the economic value added. It is clearly indicating that this particular investing on this particular project is not going to create value to the business. It is recommended to not to invest on that particular project. So here I have mentioned that WACC calculation, how WACC is obtained. Weights of equity into cost of equity plus weights of debt into cost of debt, that is a 0.56 into this is a weight of equity into 0.18 cost of equity plus 0.44 is a weights of debt into 0.09 is a cost of debt. When we subtract and when we ascertain, 14.04 is a discount factor. Here we have incorporated that particular discount factor and we obtained present value of EVA with the help of discount factor. So let's moving on to the next slide. So that is a net present value. That is a cash flows is around NOPAT plus depreciation. When we add, we will get 1,700. So this is the cash flows with the help of discount factor. When we multiply, we will get the present value. So that is by accumulating all the present value, that is 4,949, we will get initial cost, whatever the initial investment is around 5,000. So here, after evaluating this particular project, that economic value added and net present value, it is indicating that not to invest on this particular project because it is not economically feasible. The company is not going to get value by investing on this particular project. So this is also similar to the earlier sums, that is a project evaluation using the economic value added and net present value. So here also investment outlay is around 2,000, economic life is around 6,000. So when we subtract 2,000 divided by 6, we will get depreciation. So debt to equity ratio in this particular case is around 3:1 ratio. So depreciation here I have mentioned that 2,000 divided by 6, we will get 333 as a depreciation. So scrap value is nil. Tax rate is around 35%. Annual revenue is 2,500. Annual cost is 1,500. Here also they did not give directly discount factor. We need to ascertain with the help of WACC, that WACC formula, that is weights of equity into cost of equity plus weights of debt into weights of debt. So let's moving on to the, so working here worked out, I have worked out separately. EBIT will be calculated with the help of sales. So sales is 2,500, cost of goods sold is 1,500. So we will get EBITDA or net sales, that is 1,000. And that 1,000, when we deduct 333 as a depreciation, we will get EBIT. So on that EBIT, when we deduct interest, we will get EBT, that is 532. So tax is around 35%. When we deduct tax, we will get earnings after tax. So cash flows will be EAT plus depreciation. When we add back onto the depreciation, we will get exact cash flows. So NOPAT will be like EBIT into 1 minus tax, that is EBIT is around 667, 1 minus 0.35. 0.35 is, which means 35% of tax. So when we multiply with the this, we will get exact NOPAT, that is 434. WACC calculation, here I have mentioned that weights of equity into cost of equity plus weights of debt into cost of debt into 1 minus t. This is pre-tax, so that we need to deduct tax component. So in the debt cost of debt, So after deducting, after ascertaining, we will get 10.316% as a discount factor. So EVA calculation will be clearly mentioned that NOPAT is around 434 for each year. Invested capital in the first year is 2000. After deducting 333 as depreciation, we will get next year invested capital. Till sixth year, we will get 335 as a invested capital. Capital charge, that is capital charge will be charged on invested capital around the year. We have obtained that 10.316% as a discount factor. So here when we when we charge discount factor on economic value added, we will get present value of EVA. So after accumulating all these present value of EVA, we will get total present value, that is 1302. Yes, here it is a positive sign. The project is going to creating some amount of value to the business. With the help of a net present value, also we will get to know whether this project is economically feasible or not. So net present value is around cash flows is around 767 for each year. Discount factor is around 10% as we obtain. That is after multiplying cash flows into discount factor, we will get present value. After accumulating all the years present value, we will get total present value, that is 3,338. After deducting initial investment is around 2000. Yes, we are getting some positive value. So this positive sign, which means the project is generating some amount of value to the business. So on whichever the projects are giving good returns, good good value to the business, on that particular projects only the company usually invest. This is the major funda of the economic value added. Let's moving on to the next topic, that is market value added. So what it means, this is also one of the approach. This is also one kind of method in value based management. So this, let's say we have borrowed around 100 as equity share capital. We brought around 100 just for time being, or one simple example. So 100 rupees we borrowed as a equity share capital, and 200 rupees we borrowed as a debt capital. So it is around 300 as a capital employed is around 300. So if the company is making or generated around 500 market cap is there after 5 years, yes, the company is created some amount of value to the business. So what is the initial capital employed is 300. So what is an as of now market cap is 500. So when we subtract with these two, we will get 200. So this is the market value added. The difference we call it as market value added. Some additions is happening to the capital employed. We will get to know. So with the help of this market value added, let us try to understand with the help of some practical illustrations as well, the difference between the equity market valuation of a company and sum of adjusted book value of the debt and equity invested in the company is called market value added. So market value added is said to be unique. It is ability to gauge shareholders value creation because it captures the both valuation and degree of wealth enrichment. How much enriched? Let's say I already given one simple example, that is 300 is the capital we incorporated, or we borrowed 300. So as of now, capital cap market cap is around 500. So yes, the company generated around 200 as a value creation to the company. So the market assessment of how effectively firm managers have used the scarce resources under this control, as well as how effectively management has positioned the company on the long term. How well the company incorporated some strategies to maximize their shareholders value in the company. So this particular market value added will be computed with the help of market value minus how much in the initial, what is the book capital. We will get to know the difference between market value minus invested capital is a market value added. So this we will try to understand with the help of one simple case study, that is market value added in a value based management system introduction. So this case study speaks about so what is the initial investment, and what is the market cap as of now, how to maximize the shareholders' wealth. So with the help of this particular case study, we'll get to know though. So market value added is a key performance metric in value-based management systems. It measures the difference between the market value of a company and the capital contributed by the investors, both equity and debt. So a positive sign of market value added indicates that the company has created wealth for its shareholders beyond their initial investments. So as I already given one simple example, that is 300 is their initial investment. As of now, they've grown around 500 as their market cap. So with this one simple example, we'll get to know, yes, the company is making value to the business, creating wealth to the shareholders. So this particular case study example, I have taken ONGC, Oil and Natural Gas Corporation. So background of this particular company is about the Indian energy sector underwent significant changes after the liberalization and privatization in 1990s. So one and the other way, the energy sectors are trading across the global counterparts. So companies like ONGC faced increasing pressures to maximize the shareholders' value. At that particular time, what happens? Liberalization happened. So trading doors are open to across borders. So on that particular stage, so that is very pressure on that particular stage to maximize the shareholders' value, prompting a shift toward value-based management practices. How to adapt new strategies to create value to the business. Investors begin to demand more than just high returns. They wanted to sustainable value creation. At that particular time, what happens? Doors are open to global counterparts. So they are not asking companies to create short-term profits. They are asking companies to generate long-term returns to the investors. So that we call it as a sustainable value creation, as reflected in metrics like market value added. So so this is the one of the major key metric for assessing the how much the company is able to generated value to the business. So with the help of with this market value approach, we will get to know. So implementation of value-based management. So this particular value-based management in how to adapt it, in how it is played a vital role in value-based management. So ONGC adopted a value-based management system focusing on market value added, economic value added, and cash value added as the key performance indicators. These are the key performance indicators in the value-based management, that is a market value added, economic value added, and cash value added. So strategic focus is about the company aligned its strategies, operations, and performance metrics to maximize long-term shareholders' value. So the corporate people are aligned, and they structured and they planned their strategies, operations, which are aligned with the to maximizing the long-term shareholders in the company. So the performance measurement is about ONGC regularly assessing its performance using market value added and comparing the market value of its equity and debt to the capital invested by the shareholders. So results and analysis will be like correlation with share price. So studies found a strong relationship between ONGC and market value added. Let's say uh, the company created good value to the business. Then it is a by default, it is a by default effect that share price of that particular company is going to increase. So it is indicating that improvements in the value creation translated into higher market valuations. So value creation by focusing on market value added, ONGC was able to identify and invest in projects that generated returns above cost of capital. So let's say I already discussed this with this. So that is, if the company is able to meet minimum requirement, minimum cutoff rate, that is cost of capital or weighted average cost of capital, then and there only the company is able to generating value to the business. So leading to positive market value added, and it enhances the shareholders' wealth. So comparison with traditional metrics like market value added and other value-based indicators provided a more comprehensive measures of performance compared to the traditional accounting metrics like return on investment and earning per share. These are the traditional accounting metrics: return on investment, earning per share. These are the traditional. So modern key metrics is around about CFROI, cash value added, and economic value added, and market value added. These are the modern techniques to evaluate the value of the company. Moving on to the next slide, that is additional insights. What are the insights about this particular case study? So this empirical evidence research on German listed firms also shows that companies adopted value-based management. So whoever the companies are adopted value-based management systems, including market value added as a metric, experience statistically significant. They experienced that statistically they grown and economically sustainable abnormal stock market returns during the adoption phase. So this supposed to view that value-based management adoption is a credible signal of management's commitment to the shareholders' value. So when it comes to practical applications, other case studies such as those involving Hershey Food Corporation demonstrate that market value added along with other value-based metrics, it is highly correlated with market performance and is essential for effective strategic planning and performance evaluation. So let's moving on to the next slide. That is key lessons from this particular case slide is about aligning aligning with shareholders' interest. So their strategies, these operations, their plannings are aligned with the shareholders' interest. That is generating value to the business. So market value added helps ensures that management decisions are aligned with the goals of maximizing the shareholders' wealth. So strategic resource allocation, companies are using value-based management and market value added can better allocate resources to the projects that generate the most value. As we already discussed in the practical illustrations, that whichever the projects are economically feasible, whichever the projects are giving more returns, so over and above the cost of capital on that particular project only the company supposed to invest. Otherwise, it is not going to create value to the business. Long-term focus, unlike short-term profits measures, market value added encourages a focus on sustainable and long-term value creation. So when it comes to conclusion part, market value added is a powerful tool within the value-based management system. This is the one of the key vital approach by evaluating the how much the how much company generated value to the business with respect to their its initial investment. So providing a clear measure of value creation for shareholders and also real world cases like ONGC, how ONGC adopted strategies to implement and sustain in the long term value creation by opening their subsidiaries in the global counterparts, and empirical studies across industries confirm that focusing on market value added leads to the better strategic decisions. So this improved the market performance and sustainable shareholders' wealth. So here I have given market value added analysis with respect to this particular case study. So in the initial stage, what happens in the blue in the blue color, whatever the diagram it is showing, this is the initial investment. This much is the initial investment. What happens over a period of time, this much the company is able to generate value to the business. So let's moving on to the next slide. So interpretation for this ONGC market value added chart, that so market value added measures the difference between the market value of the firm and capital invested shareholders and debt holders book value. So it indicates how effectively company has created wealth for its shareholders. Its shareholders. Case data summary. As I already discussed, initial investment is in the yellow. I mean blue sign, that is this much they would have invested in the earlier. So they are able to generate this much in the over a period of time. So here you can see here the in the earlier they would have invested around 7 lakh rupees. I mean, sure, for time being, let us try to understand book value is around 7 lakh. So as of now, market value is around 12 lakh. Got it. So when we compare both this, we will get to know what is the exact difference between the book value and market value. If it is a positive signal, so we will get to know that yes, market value added, some amount of value has been added, some amount of value has been created. So interpretation for this particular case let is about ONGC has a positive MVA around 5 lakh, which means the market perceives that the company has created substantial value over the capital employed. A positive MVA signifies effective strategy implementation, operational efficiency. They have a good operating efficiencies over the global counterpart after the liberalization. So, and also strong investor confidence. They would have attracted investors. So by with the help of some attractive dividend payouts, and the company ability to generate return above the cost of capital and maintain a favorable market position likely to contribute to this value creation. So strategic insights with respect to this particular case that is about the positive MEA always validates that how in this adoption of value-based management. So yes, the company is adopted value-based management, implementing strategic strategies in their business to maximize their operational efficiency. So with the help of that operational efficiency, they are able to make some good sales. With the help of that good sales, the company is able to making a value to the business. So, and also tools such as economic value added and cash value added. It also reflects the market's approval of ONGC's strategic alignment, performance metrics, and long-term value focus. Their main focus is about long-term value creation. This will be assessed, this will be ascertained, this will be evaluated with the help of market value added, economic value added, and cash value added. So let's moving on to the next slide. That is, these are the one simple illustrations I have mentioned. You can see over here, market value of the firm is around 12,000. Let's time being, it's a simple example. Understand that 12,000 is it is a market cap. So its economic book value with respect to book value is around 10,000. When we compare and contrast this between market value and book value, 2,000 is the difference. So this 2,000 is about market value added. Yes, the company is able to created some amount of value. So the market capitalization of the firm is around 12 lakh, and the firm has equity capital around 2 lakh, and the debt is around 5 lakh. What is the market value of the firm? So MVA is equals to, as I already discussed, this is in the initial stage, that is market value is around 12 lakh minus capital invested. How much they would have invested? Around 2 lakh of equity and 5 lakh of debt. When we add both this equity and debt, we will get 7 lakh. On this 7 lakh, on 12 lakh, when we deduct 7 lakh, we will get 5 lakh as a market value added. Higher the market value always indicates that better it is for the company. The company has substantially created value to the business. It indicates that the business company has accumulated wealth for shareholders. Market value added is also equal to the present value of the future expected economic value added. Moving on to the next slide. So that is a BCG significant role in value-based management. So as BCG, Boston Consulting Group, it is also one of the consulting software group. That is so first of all, let us try to understand what do you mean by BCG BCG tool. What is this exactly means? This is also one of the strategic management tool which is available for the company to assess the which are the product lines which are doing well in their business. So let's say BCG is it is divided into 4 sub parts. That is, first one is question mark, and the next one is star, next one is cash cow, the last one is dog. In the initial stage, whatever the company is launching new products to the market, that is in the initial stage, that is question mark. There is no market share, but has a market growth is there, because they would have done some prior research and development things. Yes, this particular product is going to capture it in the future. So that is they introduce it in the initial state, that we call it as in the question mark stage. When it comes to star product units, in that particular product units, what happens, they would have invested, they would have launched some amount of goods. That particular goods are captured market value, and also they are able to generating more amount of cash flows to the business. So these are we call it as stars. When it comes to cash cows, in this particular thing, what happens, high market value is there, but there is no growth is in there because of because of consumer preferences, all these things which influences the product preference. When it comes to last one, that is there is no growth for the product, and also there is no market share in the product, that is in the dog. We call it as that in that particular product line, I mean product unit. So usually companies divest on dog product unit products, not to produce. So this is the simple meaning of BCG. Those are the Boston Consulting Group plays a pivotal role in. So with the help of this strategic management tool, they will get to know which product units we need to invest, on which product we need to divest. So the Boston Consulting Group plays a pivotal role in the development, implementation, and advancement of value-based management systems across industries. Boston Consulting Group methodologies and frameworks helps organizations to align their strategies, operations, and performance metrics with the ultimate goal of maximizing the value creation. So the key contributions of the BCG to value-based management. So development of analytical tools and frameworks, BCG metrics, growth share metrics, we also call it as growth share matrix. BCG introduced the growth share matrix, a portfolio management tool that helps companies to prioritize business units. Let's say I already explained you earlier they are prioritizing which product lines or which product units are giving more returns to the company, which are not doing well in the market. When they need to identify, they need to divest, they need to stop that particular manufacturing of that particular product. So these are the things which will done in BCG strategy evaluation process. So with the help of this, the company is able to create some amount of value to the business. So market growth and market share, this matrix guides the resources allocation to the maximize. Let's say huge amount of invested in star, so that is going to create that is going to generate cash flows to the business. Yes, this is the thing. So always most of the business that they usually invest invest on star, because star under star product units, because those product units are generating value to the business, are generating more cash flows to the business. So value science center, that is BCG value science center, provides advanced analytics for targeted value creation, helping organizations to optimize capital allocation and financial policies to drive the future value. So implementation of value-based management systems. So how it has to be implemented. The end-to-end value focus. BCG encourages organizations to shift from siloed management of costs and outcomes to an integrated end-to-end view. This enables better identification of value drivers and more effective management of both costs and outcomes. So as I already discussed with you guys, that is in the question mark, what happens, cost is incurred much, there is no cash flows is happening in the question mark. So they need to assess the future opportunities on that particular product. They need to go with that. After that, data driven insights. BCG leverages data analytics to the benchmark performance and also identify best practices and inform decisions that enhances the value creation across the organization. Let's moving on to the next, that is driving value-based transformation in healthcare. BCG is the leader in value-based management healthcare, because with the help of this particular BCG approach, or BCG uh, Boston Consulting Group strategic management tool, which are the products are doing well. So they need to assess and they need to know which one they supposed to invest, and which one they're not do not supposed to invest. So helping the health systems and insurers improve patient outcomes while controlling the costs. Their frameworks enable the measurement and comparison of outcomes, identification of best practices, and smarter resource allocation. So this BCG co-founded the international consortium for health outcomes and measurement. So setting global standards for outcome measurement in the healthcare. So let's moving on to the next, that is linking sustainability and wait just a minute. So linking sustainability and value creation. So BCG approach or research demonstrate that integrating the sustainability initiatives into core business strategies can drive the both financial returns and long-term resilience. They advise companies to anchor sustainability efforts in value creation to meet the investor expectations and secure the competitive advantage. So in the conclusion part, that BCG frameworks, this is the one of the strategic management tool. Consulting expertise form the backbone of many value-based management systems. This is also one of the plays a pivotal role in the value-based management. So by focusing on analytical rigor, strategic alignment, and data-driven insights, BCG enables organizations to make the decisions that consistently drive the long-term value creation, adapting the changing market demands and meet the shareholders' expectations. So this BCG approach, an international consulting organization, has developed an approach to shareholders value management that is going to build on the pioneering work on their specialist group Halt Value Associates. The approach takes two measures into consideration. One is a total shareholders return, and the other one is a total business return. So what is this total shareholders return? The rate of return shareholders earn from the owning a company's stock over a period of time. So according to BCG, total shareholders return is a comprehensive measure as it includes the dividends as well as the capital gains. So what is the formula for total shareholders return? For obtaining total shareholders return, that is dividend divided by beginning market value plus ending market value minus beginning market value divided by beginning market value. This is the formula available for ascertaining the total shareholder value. Then the next one is total business return. For this, free cash flows divided by beginning value plus ending value minus beginning market value divided by beginning market value. These are the formulas available to ascertain the total business return and total shareholders return. Moving on to the next slide, that is BCG recommends these approaches for. So this is the approaches in BCG. BCG strategic management tool, that is strategic planning, resource allocation, incentive compensation. Strategic planning, evaluating the alternative plans in terms of total business return, which are the projects are giving more returns. So total business return to reflect upon the actual trade-offs among profitability, growth, and cash flows. So after that, resource allocation based on based on based on resource allocation based on based on total business return, those projects which generates cash flows CFROI greater than the cost of capital will be provided with reinvestment amount. This done for both assets in place and the assets to be created. So what is about incentive compensation? Using total business return, the value creation metrics for a multi-layer and multi-year horizon can be obtained, and this can be linked with the target performance measures, as bonus and incentives are directly linked with this agency problem is solved or aligned with firm value and divisional value creation. So let's moving on to the next, that is cash flow CFROI. So these are the proxies, these are the metrics available in the valuation of the company. So in the accounting approach, ROI and EPS are the proxies. Here CFROI, EVA, and cash value added are the proxies to ascertain whether the company performance is good or not. So total business return incorporates the return CFROI both for the assets in place and the assets to be created. CFROI is a sustainable cash flow. This is a sustainable cash flow because we are deducting economic depreciation in the cash flows. So we will get the sustainable cash flows a business generates in a given year as a percentage of cash invested in the firm assets. Sustainable cash flow is a gross cash flow less economic depreciation. It is an inflation adjusted measure. It is actually inflation adjusted measure. So this is the true economical worth of the company. So CFR for computing CFROI, so formula is cash flow minus economic depreciation divided by the total amount cash invested. So economic depreciation, so it is the amount annual sinking fund. So this is the amount of annual sinking fund. It is kept aside for replacement of one particular asset at the end of the at the end of the life of an asset. So for computing, economic depreciation is equals to replacement cost of assets divided by future value of interest factor of annuity. So replacement costs of assets and divided by future value of interest factor of annuity, we will get the economic depreciation. And the next one is return on capital employed, ROCE. For that, NOPAT divided by book capital or EBIT divided by total assets minus total current liabilities, we will get the return on capital employed. On return on gross investment, for this we need to compute cash flow divided by cash invested. We will get return on gross investment. Moving on to the next slide, that is cash value added. So this particular, try to understand CFRO is CFROI is, it is a sustainable cash flows for a given period of time, and also we are adjusting with the inflation rate. So with the it is an inflation adjusted measure. So for this one, for this we will get to know this is the proxy for the valuation of particular company performance. And also cash value added as well. The measure of economic profit developed by the BCG Associates is a cash value added. So the main merit of cash value added approach over EVA, it is removes the accounting distortions. So it removes the accounting distortions, that is cash value added, operating cash flows minus economic profit, economic depreciation minus capital charge on gross investment. We will get cash value added. What is the exact amount of cash is generated for the company. So moving on to the next slide, that is problems on economic depreciation. So first one is, so let us try to understand with the help of some practical illustrations. So first one is, just a minute. So a plant has an economic life of 14 years and cost is around 2,50,000 to replace at the end of the life of an asset. The cost of capital is around 10%. What is the economic depreciation? So as I already mentioned in the earlier, that is to obtain the economic depreciation, replacement cost divided by future value of interest factor of annuity. So for that interest factor of annuity, they see here replacement cost they already given 2,50,000 is a replacement cost at the end of the life of an asset. So for that already available future value of interest factor of annuity. For that we need to obtain 1 plus r to the power of n divided by r. We will get future value of interest factor of annuity. With the help of this we will get economic depreciation, that is around 8,938. So let's moving on to the next slide. So the next illustration is on economic depreciation, that is a machinery cost is around 2 million and has an economic life of 10 years, at the end of which it will have a nil salvage value. There is no salvage value is involved. If the cost of capital is 15%, what is the annual economic depreciation charge? So with the help of this we will get to know. So as they already mentioned that 2 million is the replacement cost. So we don't know future value of interest factor of annuity. For that here it is this is the formula we will obtain, that is 20.30 is the future value of interest factor of annuity. So economic depreciation is equals to 20 lakh divided by 20.30. We will get the exact economic depreciation of the company asset of an particular company. So let's moving on to the next slide, that is, so an equipment cost we will ascertain accounting perspective calculation of depreciation as well as economic depreciation. An equipment cost is around 20 lakh and has an economic life is around 4 years, at the end of which its expected salvage value is around 6 lakh. If the cost of capital is 15%, cost of capital or WACC or discount rate, one and the other same thing. So what will be the depreciation schedule under the sinking fund method? Sinking fund method is different. Accounting depreciation method is different. So let us try to work out first, that is sinking fund method. Summary table economic depreciation in the year column 5 year they already given they already given 5 years. I mean, for 5 years we need to obtain for depreciation of economic depreciation. That is, we need to obtain first future value of interest factor of annuity. That is 1 plus 0.15. That is cost of equity into raised to the power of 5, fifth year, minus 1 divided by minus 1 divided by 0.15 is the cost of capital. We will get annuity factor. So investment amount is around 1 lakh. So EOD 1 lakh divided by 6.74, we will get 14,834. So after deducting after dividing 1 lakh divided by 6.74, we will get 14,834. So when we charge capital charge on 1 lakh, whatever the investment amount is, that is 1 lakh on that, when we charge 15% of capital cost of capital, we will get 15,000 as a capital charge. When we deduct economic depreciation 14,834 on 1 lakh, we will get next economic depreciation, that is 85,164 on this particular amount divided by 4.99, that is a future value of interest factor of annuity. We will get economic depreciation for the next 1 year. So we can observe here, over a period of time, over a replacement year, what is happening. The economic depreciation of the particular asset is increasing trend. So let us try to look into accounting perspective. That is that is straight line method. That is for 5 years, core investment is around 1 lakh, depreciation is around 20,000. That is 20%. Wait just a minute. Salvage. So here we need to calculate for depreciation for each year in the accounting perspective. That is 1 lakh, 1 lakh minus salvage value is 0 divided by 5 years. We will get 20,000 for each year as a depreciation. So 20,000 is a depreciation for each year. So closing balance will be 80,000, 60,000, 40,000, 20,000. At the end of the year, there is no amount is left to replace the that particular assets. This misleads the true worth of the asset in the accounting perspective. So this is not the right way of treating or computing the depreciation. So capital charge is also like there is in a decreasing trend. At the end of the year, there is no amount is left in the to charge the capital charge. So let us try to understand with the help of explanation. That is just a minute. Yeah, explanation for a straight line method versus annuity method. What is the exact difference between this straight line method and versus annuity method? So straight line method, in the straight line method, what happens? The depreciation amount remains constant for every year. So however, the capital charge, cost of capital and book value decreases year by year. Year by year, what is happening? Decreasing trend is there. So since it's calculated on the declining book value of the asset, so as a result, the total amount of set assets, whatever we are kept aside for replacement of that particular asset in the end of the year, gradually it is reduces. So this is not the right way of computing the depreciation. Therefore, the amount of accumulated over the asset's life may be insufficient for fund the replacement cost of the asset at the end of its useful life. So conclusion, this method may not be adequate for financing reinvestment in the replacement assets. So when it comes to annuity method, in the annuity method, what happens? Depreciation is calculated in such a way that total charge, whatever the total charge, depreciation plus capital charge remains more uniform over the years. This is the uniform over the years. So capital charge decreases as it is based on the declining asset value. So then, but the depreciation component increases accordingly to the compensate. So to compensate at the end of the year, it is in the increasing trend. So this ensures that the total amount set aside, whatever we are keeping aside for every year to replace that particular asset at the end of that particular asset so life, set aside each year remains adequate for replacement purpose. When it comes to conclusion, this method ensures that financing or for reinvestment is more reliable and sufficient over the life of the asset. So let's moving on to the next slide. So similar to the earlier sum, that is a machine costs around 1 lakh and has an economic life around 5 years. And the cost of capital is 15% and the salvage value is nil. Show the summary of depreciation and capital charge both under the SLM method and the sinking fund method for depreciation. So here if they given a machine costs around 1 lakh and has an economic life of 5 years, we need to compute for 6 years. This is a thing we need to one thing we need to keep in mind. That is first we need to ascertain future value of interest factor annuity. For that 1 plus 0.13 cost is around just a minute. So here cost of capital is around 13%. That is we have mentioned on the 6th year minus 1 divided by 0.13 is the uh, cost of capital. We will get annuity factor, that is 8.32 for the 6th year, 6.82 for 5th year, 5.85 for 4th year, 3.41 for 3rd year, 2.13 for 2nd year. First year is around 1. So what is the reinvestment amount is around 2,50,000. So 2,50,000 is the 2,50,000 is the just. So 2,50,000 is the investment amount. On this particular amount, when we divided by 8.32, we will get economic depreciation. On this 2,50,000, when we charge 13% of capital charge, we will get 32,000 5 year. Similarly, we need to do for around 5 years. So in the accounting perspective, so 2,50,000 is a core investment. So depreciation will be charged 2,50,000 divided by 5. We will get the exact depreciation amount for each year. This is the exact amount for each year. So closing balance will be this much after subtracting 2,50,000 minus 44,667. We will get closing balance. On this particular amount, we need to charge the capital charge. So likewise, we need to ascertain with the help of straight line method in the accounting perspective. Let's moving on to the next slide. So definition and let us try to understand with the help of on theory basis, definition and conceptual basis of sinking fund method of depreciation calculation and straight line method of depreciation calculation. Accounting depreciation is the systematic allocation of the cost of the tangible asset over its esteemed useful life. This process is governed by accounting standards and tax regulations. Its primary purpose is to match the expense of the using an asset with the revenue it's generated. So it ensures that accurate financial reporting and compliance with the tax laws. So for the purpose of financial reporting, they usually compute a straight line method. Straight line method. When it comes to economic depreciation, in contrast measures the actual loss in the market value of an asset due to factors such as wear and tear, technological obsolescence, changes in the market demand, and external economic influences. It reflects the real world decrease in the asset's worth, which may not follow a fixed schedule and can be influenced by unpredictable events or market conditions as well. Let's moving on to the next slide. That is how differentiates the economic depreciation with respect to the accounting depreciation in the value-based management. So economic depreciation and accounting depreciation are both methods are recognizing the decline in the value of the assets over the period of time, but they serve different purposes. So these are calculated differently and have a distinct implications in value-based management systems. Understanding these differences is essential for managers, investors, and the analysts seeking to accurately assess the asset value, make informed decisions, and optimize the long-term value creation. So calculation methods how will be then for accounting depreciation and economic depreciation, we'll try to look into. So for accounting depreciation, schedule based calculate using the standardized method like straight line method, diminishing balance method over a predetermined period, the assets useful life. So predictable, the expense is recognized annually in financial statements often until the assets book value reaches zero or its salvage value. predictable. The expense is recognized annually in financial statements, often until the asset's book value reaches zero or its salvage value. Regulatory compliance adheres to guidelines set by accounting bodies and tax authorities. So, so these are the and this is the in such a way that the accounting depreciation is calculated. So when it comes to economic depreciation, it is driven by market, and also irregular and complex. It is appraisal based. So market driven, it is based on changes in the asset market value, so which may fluctuate due to the external factors like technological change is happening in the market, and market trends are going changes, and also economic downturns also. Based on these factors, uh, economic depreciation or the value of an asset will be determined. So irregular and complex, the rate and timing of depreciation are not fixed. So for example, a sudden market shift or new technology can rapidly reduce an asset's value. So with the help of market perspective, economic depreciation has to be computed or ascertained. So when it comes to appraisal based, it is often determined through periodic appraisals or market assessments, especially in the sectors like real estate. So implications in the value-based management, accounting depreciation in value-based management, expense matching. So it ensures that the cost of using assets is matched with the revenue, providing a consistent basis for evaluating the profitability. Tax planning, since the depreciation is tax deductible. As we all know that interest and depreciation are the tax deductible components. It reduces the taxable income and affects after tax cash flows, which are central to value-based metrics like economic value added. So when it comes to limitations, it may not reflect the asset's true economic value, especially if market conditions are changing rapidly, like technological changes is happening. So at that particular time, straight line method or accounting depreciation is not the a superior method to ascertain the value of the business, and also during the economic downtrends as well. So let's moving on to the next slide, that is economic depreciation in value-based management. So it is basically true value assessment to ascertaining the true value of the asset. Provides a more accurate measures of a real decline in the asset value. What is the exact value decline in the future? It is a crucial for investment analysis, capital budgeting, and strategic decision making. And also in the investment decisions, like helps to managers and investors assess whether to retain the that particular asset or upgrade or dispose of assets based on their actual market worth. So risk management also involved in the economic depreciation. By considering the economic depreciation, companies can better anticipate and respond to the changes in market conditions, like avoiding overvaluation of assets and their balance sheets. Moving on to the next slide, that is explains examples and case applications relating to the economic depreciation and accounting depreciation. In the example one, we will look into the real estate perspective. What happens in the perspective of accounting depreciation and economic depreciation? In accounting depreciation, a building is depreciated over 30 years on a straight line basis for accounting and tax purposes. It is depreciated over 30 years. When it comes to economic depreciation, what happens if a new highway diverts? So let's say in the highway road, building is constructed the traffic away from the location. So the building market value, whatever it may drop sharply in the just few years because of they shifted highway to the they diverted the highway. Because of that reason also, the building value dropped sharply in the just few years for exceeding the accounting depreciation rate. So example 2 is about technology equipment. Accounting depreciation, a company depreciates computers over the 5 years. So what happens in accounting depreciation, they will usually deduct where depreciation they will charge around 5 years in the straight line method in the accounting depreciation. When it comes to economic depreciation, a sudden advance in technology happens, renders the computers obsolete after only 3 years, causing a much steeper decline in the market value than the accounting scheduler suggests. So let's moving on to the next slide, that is strategic importance in value-based management, alignment with shareholders' value. So value-based management focusing on maximizing the shareholder value, which depends on the true economic value of the assets rather than their book values. So capital allocations, economic depreciation informs better capital allocations decisions by highlighting assets that are losing value faster than anticipated. So performance measurement. When it comes to performance measurements, metrics like market value added, economic value added, these are the proxies which are available to accurate asset valuation and the market economic depreciation, a more relevant measures for assessing the long-term value creation in the company. Early capital replacement. If economic depreciation is higher than accounting depreciation, companies may need to replace assets sooner than planned to maintain competitiveness and value. Moving on to the next slide, that is challenges and limitations. What are the challenges and limitations are involved? So challenges and limitations. So challenges and limitations of economic depreciation and this one accounting depreciation. Complexity. Calculating economic depreciation requires market analysis. We need to assess the market trends, technology advancements, and economic downtrends. We need to keep in mind all those things. Then only, just a minute. Yes, there are some challenges and limitations are involved in the calculating economic depreciation and accounting depreciation. So when it comes to complexity, calculating economic depreciation requires market analysis and appraisals and forecasting the forecasts and making it more complex and subjective than accounting depreciation. When it comes to reporting standards, financial statements typically reflect only accounting depreciation. Usually, at the time of financial reporting or financial statements reporting or annual report, they are preparing at the time of annual reports, accounting depreciation they usually follow. When it usually potentially misleads the shareholders about the true value of the assets. So and also decision making is like over reliance on accounting depreciation. Over rely, they usually rely on accounting depreciation. It can be a result in poor investment decisions, as it may mask the real economic loss in the asset value. Let's moving on to the next slide. So when it comes to conclusion part, in value-based management, the distinction between the economic and accounting depreciation, it is very critical. So accounting depreciation offers a standardized and predictable method for expense allocation and tax planning, but may not reflect the true decline in the asset value. It is not going to reflect the exact, what is the exact value of decline in the value. This accounting depreciation is not going to disclose. It usually misleads. So economic depreciation captures the real world loss in the value due to market and economic forces. So providing a more accurate basis for investment analysis, capital budgeting, and strategic decision making for organizations focused on maximizing the long-term value. And also it is integrated economic depreciation into their management systems, enables more informed and agile and value-driven decisions based on the economic by adopting economic depreciation calculations. So let's moving on to the next slide. So last but not least, that is one last approach is there. That is a marathon approach in the value-based management. Let us try to understand with the help of one simple case study. Yeah, Maracan approach in value-based management. So the Maracan approach is similar to like there are some key proxies are involved in the value-based management. With the help of these key proxies, we will get to know that as some amount of value is creating to the company. Yes, the company is creating performing well in the market. We will get to know what are the proxies. We will get to know with the help of this approach. The Maracan approach developed by Maracan Associates It is a foundational model in the value based management. It is a foundational based management. It emphasizes the maximizing the shareholders value by focusing on the relationship between the company's market value. So it is one and the similar to the MVA, market value added. What is the exact difference between, is there any positive value is added with respect to its book value? The approach guides the firm through a structured process to identify and enhance the value drivers. So for assessing this particular metric, they usually use some drivers. So this case study example, like Alpha Manufacturing Limited. So Alpha Manufacturing Limited, a mid-sized industrial equipment producer. This is involved in the equipment production. So it faced a stagnant growth and decline market value. The management decided to implement the Marathon approach to revitalize revitalize the its value creation process. So step one is about specify financial determinants of value. So analysis part, the company assessed its market to book value ratio, return on equity, and the cost of equity, and the dividend growth rate. So these are the metrics, key metrics available in the Marathon approach to ascertain the value of the company. So finding Alpha return on equity was only slightly above its cost of equity. It is indicating that limited value creation. Let's say Alpha's cost of capital is around 15%. So the company is able to generate with the help of its equity capital around 16%. So it is indicating that the company is not utilizing its equity capital in a proper way. It is able to generate only slight increase in its over and above its cost of capital. So let us try to understand. Yeah, understanding strategic drivers of the value. So, what are the strategic drivers of the value creation? So, market economics. So, what is this market economics? Alpha analyzed its industry competitiveness and forces, including supplier power. What is the power of their suppliers and the threat of new entrants in the market, and also customer bargaining power? Is there any alternative products are available to the its with respect to their products? So, and also competitive position, the company benchmarked itself against competitors and identified weakness in the product differentiation and cost structure. So competitive position is like how well the company is performing with respect to its benchmark, which is with respect to its particular sector, and also it is also identifying weakness in the product differentiation and cost structure as well, and formulate higher value strategies. Strategic actions are like Alpha invested in product innovation in differentiate offerings and streamlined operations to reduce the costs and improving the margins. Targeted high growth market segments. Expected outcome, these strategies aim to increase the equity, increase the equity spread, return on equity minus cost of equity, and accelerate sustainable growth. So let's moving on to the next slide. That is develop superior organizational capabilities. So what is this superior organizational capabilities? Leadership appointed. Uh, in the company, leadership are like management decisions or management structure also plays a vital role. This also generates some amount of value to the business. So they need to make some efficient decisions, effective decisions in the organization. For that, leadership which plays a vital role. So appointing a new CEO committed to value maximization. Whatever the present CEO is not taking a good actions, is not doing well, is not taking a good actions in the company. So we need to they need to restructure the management. So this is also one of the superior organizational capabilities, that is performance management. Introduced a compensation system linking management to pay, value creation, market to book ratio improvements, and also resource allocation, like resource allocation, they adopted a zero-based budgeting to ensure capital was allocated only to the value-adding projects. I already discussed some around four sums of economic value added. Whichever the projects are creating value to the business, on that projects only usually company usually invests. Which are the products are economically feasible on that projects only basically are usually companies usually invest on those projects only. Moving on to the next, that is a Marathon Associates, an international management consulting firm. It is founded in 1978. It recommends the firms to follow the following steps towards a value creation strategy. So specify the financial determinants of the value. Marathon approach is it is based on market to book ratio. So it is similar to market value added. So shareholders value is created when the market value is greater than the book value of the firm's equity. So book value reflects the capital contributed by the shareholders. So book value reflects always capital contributed, how much the initially in the early stage at the starting of the business, what is the amount of capital they would have invested. So what is the value of at present value of the business. So market value reflects how productively the firm has employed, how productively they would have used their capital, optimum resource allocation, and capital contributed by the investors as assessed by the stock market. So if market value greater than the book value, it creates the value. This happens when R is greater than the K. R, which means rate of return. So cost of, if it is greater than the cost of capital, then value creation is happening in the company. So higher the G, higher the growth rate, higher the market to book ratio. So a market to book ratio which depicts that yes, the company have employed its capital in such a way that yes, it has created some amount of value to the business over a period of time. If M market value is lower than the B, it decimates the value, which means it erodes the value, which is not doing well in the market, which is not performing in the industry. So if market is equal to the B, maintains value accordingly, market to book ratio. So it is not doing, it is not creating value, and it is not like, it is like a break even point. It is not making profit. It is not creating value to the business, and it is not making losses as well, which means market value is equal to the business book value. So it is maintaining the value. So how to ascertain this market to book ratio? So for that, rate of return minus growth, or return on equity minus growth rate divided by cost of equity, cost of capital minus growth rate. So let's moving on to the next slide. That is, understand the strategic drivers of the value. The primary determinants of the value are spread difference between the R and K. So as I already discussed this, if it is over and above uh, rate of return is there with respect to cost of capital, yes, growth rate is dividends. These two are influenced by the market economics and competitive position. So market economics are structural factors which determine the average equity spread as well as growth, such as intensity of indirect competition, threat of entry, supplier related factors, and regulatory pressures, customer related factors. So these are the market economic or structural. With respect to market external factors. So when it comes to competitive position is again based on the firm's relative position in terms of the equity spread and growth rate, vice versa. The competitor in its product market segment, the main factors contributing to this are product differentiation and economic cost position. Let's moving on to the next slide. That is formulate just a formulate higher value strategies. So participation strategies, defining the product market in which it will compete, in which new business the firm can compete, on which how they can expand their business, how they can launch a new product to the market. So from which existing market should be the should the firm exit, etc. So competitive strategies like to meet the competition or overcome the competition through the product differentiation, service offerings. With these, they can compete in the market. So develop superior organizational capabilities, that is institutional imperatives, the forces which lead to the divergence between goals of managers and the shareholders. So that is agency conflict. So corporate governance mechanism, accountability for creation and destruction of value. So a resource allocation system will be like fund strategies and not projections, no capital rationing, zero tolerance for bad growth, high level strategic financial control. These are the develop superior organizational capabilities. Let's moving on to the next slide. That is, this can be achieved in various ways. American approach, which speaks about how value can be created, or value creation can be achieved in various ways. Competent executive who is committed towards the value maximization. Corporate governance mechanism, accountability to establish towards activities leading to or eroding the value creation. So top management compensation plan, pay for relative performance, and also resource based allocation system, resource allocation to the strategies, not the projects, no capital rationing, and zero tolerance towards the bad growth. Let's moving on to the next slide. Let's try to understand with the help of one simple illustration. That is, a firm earns a return on equity around 25%. Its dividend payout ratio is around 0.4%. Let's say the company is earning 10% of earning per shares. The company is retaining 6 rupees and 4 rupees they are paying. So this dividend payout ratio is speaks about. So equity shareholders of the firm request a return of 18%. So what is the market price per share according to Marathon approach? So growth, we need to ascertain the growth rate, sustainable growth rate, that is return on equity into B, retention ratio. B depicts the retention ratio. So what is the return on equity is around 25%, that is 0.25 into 0.6 is the retention ratio. Dividend payout ratio is 4%. So when we deduct 0.1 minus 0.4, we will get retention ratio. How much they are retaining? They are paying 4 out of 10. How much they are retaining? 6%. 6 rupees they are retaining. When we multiply with return on equity into retention ratio, we will get 15% of growth rate. After getting growth rate, we need to ascertain that market price to book value. That is a formula for that, return on equity minus growth rate divided by cost of capital minus growth rate. So return on equity is around 0.25% minus 0.15 is around here we have ascertained or we are computed, that is 15%, divided by 0.18% is about rate of return. Rate of return or required rate of return. So required rate of return, which means discount factor or WACC or cost of capital. This much. This is the required 18% must and should the company is supposed to generate that particular return. So that is the cutoff rate. So 0.18 minus 0.15 is the growth rate. So for that 3.33 per share we will get. So let's moving on to the next slide. So results will be like after 2 years, market to book ratio is increased around 1.1 to 1.5% with respect to previous sum. Return on equity is like raised from 88% to the 12%, while the cost of equity remained 9%. So the shareholder value is the company market value grew significantly, reflecting improved investor confidence. So key takeaways with respect to Marathon approach. The Marathon approach helps the organizations to systematically identify and measure, enhance the value drivers. Which are the value drivers which are involved in the creating value in the business? So by analyzing with the help of these proxies, we will get to know whether the company is creating value to the business or not. By focusing on both financial and strategic factors, companies can achieve sustainable. So strategic factors. So financial and strategic factors. Financial, which means capital structure. or investment decisions, or managing the working capital and dividend payout decisions. These all are involved in the financial decisions. Strategic factors will be like implementation of strategies. Companies can achieve sustainable improvements in the shareholders' value. Linking management incentives to value creation, it ensures that alignment with shareholders' interests. So let's moving on to the next slide. So strategy comparison matrix, value-based management approaches. So what is the how it is aligned with one and another? We'll try to look into that. Approaches till now we understood economic value added and market value added, free cash flows, that is ALCAR approach, and CFRY, that is with respect to BCG, cash value added, Marathon approach, and ALCAR approach. So key concept is about for a EVA measures the economic profit after charging the cost of capital. So yeah, market value added, value created over total capital invested. So value created over the total they initially they would have invested 300 rupees. I discussed this example. They would have invested around 300. As of now, market cap of that particular company is around 500. So yes, the company is able to creating value to the business with respect to market value added. Free cash flows, value is present value of future cash flows. So CFROI measures the real return on cash invested. What is the exact return? What is the real economically feasible? So with respect to market analysis and market trends and technology advancements, we will get to know the true cash return. So economic profit after capital charge and depreciation. So value derived from equity spread and growth in the Marathon approach. With respect to ALCAR approach, DCF based strategy evaluation model. So metrics used, what are the formula used in the EVA? Like EVA is equal to NOPAT 1 minus WACC into capital charge for computation of economic value added. Their main focus is about operational efficiency and capital cost, and strategic strengths is highlights true economic profit and aligns with shareholders' value. With respect to market value added will be computed with the help of market value minus book value. We will get their main focus area. Their focus area is about a long-term market perception, and strategy captures market confidence and stable creation. So free cash flows will be like free cash flows is equals to EBIT, earnings before interest and tax, 1 minus T plus depreciation minus capex minus changes in working capital. We will get free cash flows. So main focus area will be like future cash flows generation. So strategic strength will be emphasizes capital discipline and investment planning. So for CFROI, cash flow minus economic depreciation, we will get whatever how much we would have invested capital. We will get CFROI. So focus area will be inflation adjusted return. With respect to inflation adjust return, we will get to know these are the proxies available in the corporate valuation. So strategic strengths will be like focus on sustainable performance, avoids accounting distortions. So CVA, cash value added, is equals to operating cash flows minus economic depreciation minus capital charge. We will get cash value added. True cash value created. What is the exact value created to the cash values to the business? It removes the gap distortions and strong for capital intensive industries. So Marathon approach is like a market to book ratio, that is a return on equity minus growth divided by required rate of return minus growth rate. We will get market to book ratio. So focus area is about strategic position and return on equity. And then strategic strengths will be like strategic view, links market value to performance and competitive advantage. So when it comes to ALCAR approach, firm's value will be like a present value of present value and FCF plus residual value, present value of free cash flows plus present value of continuing value or terminal area value or perpetuity value minus debt. We will get to the get firm value. So main their focus area is about strategy validation, whether to implement or whether not to implement. Strategy will be clear method to evaluate if strategy adds or erodes shareholders value. This is the superior method which is available to assess the whether to implement the new strategy or not. So let's moving on to the next slide. So the last part is about conclusion part to every approaches which are involved in the value-based management. Value-based management approaches are we already discussed everything. The foundation of value-based management, Alfred Rapport established the core premises of value-based management. So maximizing the shareholders' value as the central goal of the corporate management. Every corporate organizations, their main funda is about creating the value to the shareholders to attract the interest of the investors. So value-based management integrates strategy, measurement, and operations. Ensures that every decision is evaluated based on its impact on long-term value creation, not just for they look for short-term profits. They always look for sustainable growth and sustainable long-term value creation to the shareholders. The approach encourages the managers to act like owners, focusing on sustainable growth and efficient capital allocation. So moving on to the next slide, free cash flow approach. So what it speaks about premise value is determined by the present value of future free cash flows discounted at the cost of capital. So with the help of that discount factor or whatever the WACC or cutoff rate, we will ascertain that present value of future cash flows. The key strengths is like directly linked to the value creation to operational performance and investment decisions. Emphasizes the importance of generating returns above the cost of capital. Over and above the cost of capital, impact widely adopted for its clarity and alignment with shareholders' interests and forming the backbone of many value-based management frameworks. Let's moving on to the next slide. That is economic value added and market value added approaches. So economic value added, as I already discussed everything, that is measures a true economic profit by deducting the cost of capital from the net profit or NOPAT, profit after the taxes. So market value added is like it is a difference between the book value and market value. So assess the difference between the market value of the company and the capital contributed by the in the earlier stage, how much they would have invested in the company. So when it comes to key insights, a strong correlation between the EVA and MVA, making them effective tool for performance measurement and incentive systems. So it highlights the importance of exceeding the cost of capital to create real wealth for the shareholders. So this is the main goal to keep their return over and above the cost of capital or WACC. Moving on to the next slide. CFROI and CVA. So CFROI, as I already discussed this, this is ascertained with the help of inflation adjusted return. So true cash value added, what is exactly cash is adding to the business. So cash flow return on investment, CFROI, focus on real cash return generated by the investments adjusted for inflation and asset base. So cash value added, it usually measures the value created after covering the full cost of capital, including the depreciation and inflation. So advantages. So for advantages of this CFROI and CVA approaches, it provides a comprehensive view of value creation, and especially in capital intensive and industries, and it is useful for comparing performance and across the business units and industries. So last but not least, that is marathon approach and integrative perspective. Marathon approach identifies key financial strategies, drivers, value. So in this marathon approach, what happens? We look for return on equity. If the return on equity is over and above cost of capital, or what is the growth rate, and what is the ROC, return on capital employed. So such as growth and rate of return investment and cost of capital as well as. So holistic view is like all value-based management methods share the goal of embedding value creation into daily management and decision making. Successful value-based management implementation requires a value creation mindset and robust management process. Management activities and management decisions also plays a vital role in creating a value to the business, and these whatever the objectives which are our alignment of incentives with long-term value. So final thought will be like, while each approach offers unique tools and metrics, their collective impact lies in the shifting organizational focus from short-term gains to sustainable and long-term value shareholders. So this is the main fund of this value-based management systems. So creating value to the business, which drives the business in the long way, in the long term, it is going to sustain, and it attracts the investors to invest in on those particular company. So thank you very much.